Boom, baby. We are live. Welcome to Tokyo Crypto Show, episode 121. And we are going to be talking about how the economic machine works by Ray Dalio today. I'm Jonathan from the Masculine Empowerment Network. And I'm here with Charlie from cultivatecrypto.com. What's up, Charlie?
Hey, all is good. And there's some really interesting stuff going on with Bitcoin. So that's always fun.
Right. And that's what we're going to be talking about today. So here's how we're going to start the show off. First things first, we're going to take a look at Bitcoin. We're going to take a quick look at Ethereum because those are basically the blue chip cryptos. And then we're going to do a quick analysis of recessions because a lot of people need to realize that, yes, we are theoretically heading into recession. And I think the only thing that's really pinching people is gas prices. If I'm wrong, please let me know what is pinching you hard in the chat right now. But we believe gas is just the main pinch.
The
biggest. We're gonna go ahead and just talk to you guys about, this recession is. There've been recessions in the past, and everybody thought the world was going to hell then, and it's probably not. So we're not saying be dumb or whatever. But like last week when we talked about Ray Dalio, he says if you're worrying, you're gonna be okay. If you're not worrying, you should worry.
Yep.
And so Tracy Douglas says groceries are causing him trouble. Yeah. I mean, it's doable, right? Just get on the rice, chicken, and broccoli diet. You'll be all right. Charlie?
Yeah, am I coming in loud and clear enough?
You're coming in a little low.
Okay. I don't know because sometimes I know this, it's been shifting a little bit. So how about now? Any better?
Not really a change, no.
Okay. Well, just let me know if it's bad or whatever. But I think
the audience can let us know. I think audience, is he coming in okay? My hearing's kind of going, so.
Yeah, my other things are
Charlie loud and clear over here. Okay, probably just my hearing.
Good. Yeah, just double checking. But yeah, let's get on it and let's take a look at Bitcoin and Ethereum because I think the next couple days here, definitely by within the next week or so, we're gonna see basically which direction things want to go, and the price targets will be much more accurate. Because Bitcoin right now, just over the last couple days, it had a little bit of a pull up here, so that's pretty good. So yeah, let's take a look here. Let me just share this. Oops, that's the wrong button. Alrighty, let me know when you got that.
You are full screen. Go ahead.
All right then. So what basically the pattern we've been having here since the end of last year, right? Since the stock market has been going down in the DXY, the dollar index, or the dollar versus other baskets of currencies has been going up, right? We've had this downtrend, and what you notice with this downtrend since November essentially is we obviously had a pretty significant relief phase here over 2 60-day cycles. But if we take a look at the 60-day cycles, which shout out to Bob Lucas for talking, about this on the regular, because it is one of the best ways to look at timing and price levels, I think, in the cryptocurrency market, which I would think more people would be talking about, but it's basically us and Bob out here. So we have these, what we call left translated cycles. The average cycle runs about 60 days from low to low. And if you get the high before day 30, that's slightly bearish. If you get it after day 30, that is bullish. So we had a 50-day high here, right? 48-day high here. So we're still in the bull phase. And then here, once we start getting that before day 30 mark, basically, then we start getting bearish. And we've continued that pretty regularly to where we are now. So when we saw this uptrend over 2 60-day cycles, it was still bearish because it wasn't strong enough. Basically, we needed this area to basically come up here above, I believe it was about 50K was the number we needed. We didn't get it. We lost this trend line. We lost the horizontal as well as the angled trend line as well as the horizontal trend line. And we came down into another cycle low. And now the question here in this current 60-day cycle is, in my opinion, do we have what we call here a left translated cycle on a abnormally short 60-day cycle with a day 37 cycle? That does happen. And if it does, when that does happen, it usually happens on capitulation events, which just means events that basically wash out the market and end up being a local low, at least for some period of time. So we do have the option here of basically June 18th being the low here for basically this Q3, right? Because now we just turned into July in the last week. So now we are in Q3. And so this area could really be a bottom forming here, but it's not a bottom on, I don't think, on this entire year or this entire market going into the recession, basically scenario that we're pretty much already in. But yeah, so the other argument is that we basically have a 60-day cycle low incoming still, where we'll get new lows below 17,500-ish. I think the actual low here is 17,592. So basically 17,600. So we do have that bearish possibility. And to be honest, right now, I personally would favor the downside simply because the DXY, and we can take a look at that in a second, is just like hulking up to the upside, which when the dollar is strong, risk assets, including the S&P 500, Bitcoin, gold, other items tend to be, risky for people. So they usually get out of those. And a lot of people see gold as a safe haven asset, but a lot of the times it isn't. So we really, all we need to determine here is, okay, are new lows incoming, or are we already in that new 60-day cycle? So to keep it simple, what we can do here is kind of similar to what we did in the previous two trend line breakdowns that we had to continue this downtrend. Essentially, I showed you guys this one here where we have the angled trend line and the horizontal trend line. You can do the same thing with the beginning of this current cycle that we are in, where you can take the angled trend line here, pull it across. Once we broke down from that, we were bearish. You can also put a horizontal trend line here, basically at the bottoms of some of the bodies of these candles. Right, once we broke below both of those, right, we came down pretty significantly to the downside. Both of these, we lost in terms of percentage points from the breakdown here. Was about 36%, and once we broke down from here, you can argue about 42% or so, maybe a little bit less, maybe a little bit more. And so, I mean, if we did break down, right, from where we are now, which is we have an angled trend line, which if you just put the 2 points here, that we already broke down from. But what Bitcoin is trying to do is trying to recover that. And so we can also basically put a horizontal trend line here, which I talked about on the Moon Gang on Sunday night. So right now, basically, if we lose this level here, definitely we're going to have, a pretty good capitulation into the cycle low. Now, the dates to think about here in terms of to the downside are July 11th for the end of the 60-day cycle, but also on the 13th, which would be 62 days of a cycle. That is when the new CPI numbers come out for the month of June. They're reported then. We also get GDP numbers a little bit after that. And then the only other danger going into a new cycle, or if we are already in a new cycle, the other danger is around the 26th and 27th when the Fed talks about the next interest rate hike.
Right.
So there's a lot.
And I just want to clarify for the audience members who may not be at your level financially.
Yep.
So the CPI is the Consumer Price Index, and what this is just it's like a portfolio of the price of goods. So do you know what the goods includes? It's like daily goods too, like grocery, gas. What is it?
Yeah, it's all those consumer goods. I could pull up basically the schedule for them a little bit later and show all the details on that. But
right, but
yeah,
the CPI numbers coming out. CPI numbers are coming out on the 11th of July. Typically, 13th. The 13th of July. So they're not going to look too hot. And typically, when the prices don't look good, prices are be going up. Then
the main thing is
confidence in the market's going to go down, and this is going to affect potentially the price of Bitcoin. In addition to that, the Federal Reserve is also going to probably raise interest rates again in this month, which is theoretically 26th and 27th, which is going to theoretically push the market down even more.
Yep, pretty much all markets. And the other thing to add on the CPI essentially is if it's above 8.6, then it'll have downwards pressure potentially on the markets around the 13th. If it's below 8.6, then basically it actually would be good news. So we'll see what's up there in the coming days. The other thing, so that's one way. The way to look at this right now is we are negative. So we will basically bet towards the downside until we get proven otherwise, and I'll show where we can get proven otherwise. And then here is where the numbers really start to get like parabolic to the downside, which would be about 18,900 or 18,850 and below. If we did go down another, like 30-40% from, let's say we choose this area to measure from, basically at the breakdown, 36% decline essentially would be somewhere around 13,337. I do think that would be a little too extreme for that short of a period of time, but it is possible, right? I mean, obviously we had that here, but we didn't have any price support if you look at previous history in this area as much, so that could be a factor as well. So I'm looking more towards about 15,700 to 16,500 as kind of like an optimal area, especially the closer we get to the end of the 60-day cycle if we are breaking down. Now, the one area where the bulls could take a little advantage, we can just take a look at this in more of a triangle type form, because we do have a triangle pennant, however you want to call it, basically forming here. And what this does for us is basically gives us two tighter lines in the sand, because what I was looking at before was just the parallel level here, which will definitely still be valid, right, in terms of looking to the downside. So if we break below here and here, right, then we'll be even more negative, which if we look at it from this absolute level, again, that's at 18,900 essentially. So going below there, you can guarantee that we'll have more downside, and then you'll look for some buying areas. But if we do go above this area here, first, it'd be about 20,000 and some change. So we need to beat basically yesterday's high. And then if we can do that, right? So in the next day or two, if we could just get above this trend line, get above yesterday's highs on, I would say on a daily close, then we will come up most likely and match the high that we had here on June 26th, which is at just under $22,000, so 21,868. If we can beat that, and I would say to clear it even better, you'd have to get above the high that we have on the downtrend area here before we had, after that, we're basically the first area we had some bounce would be around 23,000 and some change. So we really, for the bulls, they have a lot of work to do. First, you got to get strongly above 20,500. Then you got to get strongly above 22. Then you got to get strongly above 23. If Bitcoin can do all of those three things in the month of July, despite all of those things that are happening, that have some negative pressure potentially, then that's really the only way the bulls can regain some control here. So what I think is most likely to happen, right, is that we continue to get rejected over the next few days into the weekend. We break below both the horizontal and angled trend line here and come down into that 11th to 13th area, generally speaking, which is about another week from now. Then if we get those lows, I don't think, well, like I said before, we have the potential to go down to 13,300, 12,300, but I think we'll probably hold up a little bit better in that 15, 16, maybe even low 17K range. So really interesting. To be honest, either way, we win, right? Because if you basically have sold out of some of your positions, you can buy back basically on a break above here. It is a little risky, and you have to be watching closely if you do bet on the bullish side. But if we start breaking down, then it's easy. You just sit pat until we get close to that cycle low, both in terms of time and price. Take a buy. Of course, buying at those times can feel very risky as well, but we'll likely then get some bounce off of that. So, and then, yeah, I won't get too complicated. I'll probably talk about this more on my show tomorrow in more detail. But essentially, that's what we got going on here with Bitcoin. And basically, it's a rinse repeat with Ethereum. Ethereum's actually been quite a bit more bearish. It has even, the last 60-day cycle here with Bitcoin, we had about a month of sideways action before the breakdown. Whereas with Ethereum, like you basically have been you were breaking down the whole time, right? So it's the same thing here, though, in the short term with Ethereum is basically, if you just make that pennant or triangle, right? It's the same level, the same scenario as Bitcoin, just different levels. So for Ethereum, it's essentially if we break below 1,050 or 1,040, right, it's likely to go down into the triple digits. If we break above yesterday's high, and more importantly, break above the high that we had here on the 26th of June, which is around 1,283, break above that level, and then we start coming up here potentially towards 1500, 1700, maybe a little higher, 1900. So the bulls have a shit ton of work cut out for them. The bears not so much. So basically lean towards the bearish side until proven otherwise. Last thing to see here is Bitcoin dominance. The altcoins have actually held up at their lows pretty decently. If you look at the chart on like Solana, Phantom, and other coins like that are significant layer ones, they have, they could have been bleeding below their previous lows that they had, but they're not, simply because Bitcoin dominance has given way a little bit. So essentially money stopped bleeding out of the altcoins quite as much as it had been before. And right now it's basically at a breaking point as well. If Bitcoin dominance basically on the RSI here regains that 50 area, currently it's at 48.49. If that gets regained, then you might see Bitcoin dominance come and test at 48% again, which would mean Bitcoin would be going down in price and the altcoins would be bleeding more. So I think we'll see a little bit of a dominance increase, but probably get some rejection around 44.5 or 45%. And then it'll continue down. So the altcoins will bleed, but not quite as bad as it had been during this month here from May 9th to basically a month later in June. And then the one thing I did mention before that I do think is worth noting, if I do go over to the DXY here on the main chart, if you turn this to a weekly scale.
Richard Gammon just tweeted out about this. He literally just...
Oh, really?
Like 20 minutes ago. Yeah.
Yep. I mean, you can see it's in a parabolic uptrend, right? And
this is the strength of the dollar for the people that don't know what this is.
Correct. It's a basket of currencies and showing the strength of the dollar exactly. And what you can simply do here is just kind of take a few trend lines and see how parabolic it's going. And then once it starts breaking these trend lines to the downside, that's when it starts going down. But right now, I mean, it's on a freaking tear. You can see like the most recent area of resistance that it had here from spring of 2015 to about June of 2020, that whole area should have acted as pretty stiff resistance, but it just like ripped right through those, came back, tested the tops of them as support, and then has continued up. Of course, there's more previous price action way earlier in its history, like back in the early 2000s, but essentially, right, it's just on a tear. So if it continues here above 107, right, if we do turn on our Bollinger Bands, takes a second here, it's hitting the top of the Bollinger Band. So the weekly close is in 2 days and 10 hours on this chart. So essentially, if it closes above 107, which it's right now, or just like a couple ticks shy, then it will likely continue to push these Bollinger Bands to the upside starting from next week. So whereas if it goes significantly below, like if it closes the week at like 105, right, which would be down to where it closed a few weeks ago, if it comes down to that level, then the Bollinger Bands will start to tighten up and the price will start coming in and hitting this trend line. If it breaks down, that breaks down on this trend line, then it would start to break down. But I would bet right now that it looks like it has enough strength to continue for a few more weeks at least. And if that happens going in, that will essentially be probably the thing that creates Bitcoin cycle low over the next couple of weeks. So
what does this number on the right-hand side indicate for the audience to know?
So all you really need to know, I have to go into the details of it, but basically it's just the value that the basket of currencies is valued at. So yeah, it's not too complex. But I have to look
dollars up, or what is that value?
I'll have to look it up. But the one thing with that is I'd also have to look up which other currencies that are being included in it. But I'd assume it'd be mainly like, stuff like, the main currencies around the world. So I'd have to double check that, to be honest. But essentially what we got going here is, you can see
I have it here. It's the euro, the Japanese yen, the Canadian dollar, the Great British pound, the Swedish kroner, and the Swiss franc.
Perfect. Yeah, and the Swiss franc is probably the strongest of all those currencies usually, in terms of like a kind of the gold standard among those, which is good. But anyways, the one thing you'll notice here, right, is the uptrend in terms of like this main uptrend has really been going since early January of 2021. And here
the bear market.
Well, I mean, this was not exactly right. So for Bitcoin, right, the beginning was technically April of 2021, which, yeah, you see this around May of 2021.
Oh,
like,
sorry, I thought that was 2022. My mistake. Sorry.
Right. If you go towards this area here, once it started breaking through the resistance, yeah, this was January of 2022 when it really started to take off. But like, so yeah, you can see a couple areas here where it's basically, okay, it starts to weaken Bitcoin, but Bitcoin had some strength during this time. And then from basically November/January, November of last year, January of this year, that's when it really started kicking things down. So the correlation isn't perfect. It's not like, okay, DXY goes up, Bitcoin must go down. But right now, because it is so strong, that's the effect that it's having. And so that's that on all the chart stuff in terms of like the, what you need to know there in terms of what's affecting things right now. Should I go into the list? You're good with the list of recessions at this point?
Yeah, let's take a look at that recession list you have there.
Yep. So this is, of course, according to Wikipedia. So definitely go out there and double check this information. Don't trust, verify, make sure to DYOR, do your own research. But essentially here we've had 48 technical recessions in the United States. I think a lot of people don't know that the Corona crash that we had in March of 2020 was technically a recession. Essentially, one of the things that people try to use to determine if a recession is incoming, right, is basically what's that called again? The inverted yield curve, right, where basically bonds have inverted. You guys can go look that up if you want more details on that. We've gotten that twice in the past few months, actually, which shows a very good likelihood that we are either basically already are in a recession. And the one thing you can look in terms of seeing, okay, where are we potentially in the recession? Because this will be a valid thing once I get towards the end of this point here, is basically the S&P 500, right? It peaked the same, a little bit later than Bitcoin. Bitcoin peaked in November, whereas the S&P peaked in early January, basically, right, the first week of the new year. And then it's been down ever since. So essentially, you can say that we've been in a recession here, since the beginning of the year. So about 7 months. So that, just remember that number, 7 months. And if we come over here to the list of recessions, okay, how long do recessions last? And the cool thing about this list here is that you can literally go back to the 1700s for the United States. And why are we talking about the United States and not other countries? Because the United States still has the world's reserve currency in the dollar and is basically the biggest mover in finance globally, has the biggest lockdown on money globally and power in general. So, this is where you look. But you can go here way back and see the numbers in terms of here. They have the dates of the recession, how long they were, and then the time between recessions. The time between recessions I won't talk so much about today, but the one thing is how long are recessions usually, because they don't last forever as well. And that's, we talked about that with the last couple of Ray Dalio videos the last 2 weeks. And of course, we'll go into more details with Ray Dalio's video today on terms of, the economic machine. But so you can go back here, you can see, okay, 2 years, 4 years, 1 year, 2 years, 8 months, blah, 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 blah. This was way back before the 1900s. So of course, once we get to the Great Depression, okay, now we've kind of heard about these, the Great Depression, recessions later in time. But if we come here, right, the last 2 recessions, one, we had the Great Recession, which is a year and 6 months, basically the 2008 crash, essentially. And then the COVID one, which I did mention, because a lot of people are like, did we actually have a recession during this time? Yeah, exactly. It was nothing, right? And this was basically due to all the money printing. And the reason why we're currently going into recession is because of all the quantitative tightening, all the not money printing, right? So the deciding to raise rates and not print as much money is having the opposite effect. So we have one that's 2 months. So you can assume, right, that we'll have a little bit more time, in the next recession. But if you average out these times, most recessions usually last about a year and about 18 months, so about a year and a half. So if you know that, we can go back to why this was relevant. If we've been in a recession already for 7 months, if you're just looking at the S&P as one example, it's not the main thing to look at, but you could look at various things. But essentially, if we've been in a recession basically for 7 months now, or 6 full months, then that means another year, right, of more downwards pressure on traditional assets, which also bleeds into Bitcoin as well, because it is not immune to the global economy, which we'll talk about in detail in Ray Dalio's video today. But if we have another year, here's where it gets really interesting. So Bitcoin actually peaked here 2 months, right? In November. It was about November 15th. So about a month and a half, 2 months before the S&P. Why is that? Simply because, well, the DXY had a big effect on it, but also Bitcoin and cryptocurrency are the most liquid things that we have out here in terms of people want to get their money out of a market. People want to get their money quickly. Bitcoin's the easiest thing to liquidate, right? Because it's 24/7. You can sell into stable coins, if you can't get out into your bank. And so it's the easiest thing to buy and sell. And that's also why so it goes down faster and more significantly for some of those reasons. But also that has the opposite effect to the upside, which is Bitcoin goes up the fastest and pumps the hardest out of pretty much every asset over the last 10 years, simply because it's the most liquid and it's still in its early stage of price discovery compared to something like the S&P, which has been around way, way longer than Bitcoin, right? So if Bitcoin peaks earlier than other things, it also bottoms earlier, potentially, right? It's not a guarantee, right, but potentially than other markets. So, and the most illiquid thing, if we're looking at traditional markets, is mainly real estate. And so that is probably something that will bottom more closer to that 18-month period, which would be about this time next year. So next summer. So this kind of gives us an idea a little bit of where we can kind of go with, lows. So for me in particular, what I'm thinking is Bitcoin and tech stocks, because tech stocks make up a big portion of the S&P 500, have, at the worst case scenario, right, they bottom along with everything else about this time next year. But more than likely they start rebounding earlier, which I think is by the end of this year. For Bitcoin in particular, that does line up with the 4-year cycle if you're looking at it in that lens. So that's, just nice as well, if that basically continues to stay in that pattern. So that's the gist of kind of what's going on right now if we're looking at these things from more of a macro sense. But I will throw this link in the chat because I do encourage people to go out there and do their own research. Don't trust, verify. I mean, that's what we do here in crypto. That's why we are here. But I know a lot of people, right, they don't do enough research, which is why, people have trouble, right? You really do want to, take this information and run with it. The main reason why we do this show for you guys is not only to give you information that you can learn on, but also that you can take the baton and run, the next lap. Because if you don't do these things, if you don't take that self-responsibility, if you don't try to push yourself in terms of your knowledge base and growing in these subjects, then you'll still do better with this information than not with this information, but you'll do way, way better if you can take on that level of responsibility, which is definitely, part of the being in the red pill. So, yeah,
it's a big thing to consume here. But I think that, obviously we're part of the men's self-development thing, and that's why me and Charlie started this show, which, catapulted the Cultivate Crypto show, which is Tokyo Crypto Show. Started this 17 episodes after I started my live stream.
Yep. February of 2019.
Yep. Famous words of you when you first hit the internet. Hey, y'all.
Two dudes, one mic. Hey, y'all.
Two dudes, one mic. But we just realized that there's a gaping hole in men's financial education. Really, all humans. But we here, our expertise is obviously talking to men, and crypto is heavily male dominated. And that's because it's hard to understand. And men have a little bit more of a natural knack for mathematics. And that being said, we just really want to do our best to educate you guys on what's going on. You know what I mean? Because if you were just to pay attention, the worst thing you could do is pay attention to anything on the news. I mean, they're consistently wrong. They're consistently have an agenda, and that agenda is to stir up your emotions in a negative manner. So you become addicted to them to come watch and get your next fix. And, oh, what's happening here? Is this, and they really never offer solutions. So we're looking like, in my opinion, I think we're going to bleed out here. I think it's not going to be fun for the rest of this year and 2023. And I think we'll start 6 months before the halving. We might start to see some life in Bitcoin. And this is my perspective of things, more of a macro, my perspective. Because
And well,
another
it
thing is,
also depends on, are you looking at, because like this is the problem people made in 2018, 2019, right? Are you looking at, once we hit the bottom and we start moving up, or are you looking at when we hit new all-time highs? Because what confused people in 2019 is we basically found the bottom at the end of 2018, right? So the end of that downturn was basically the end of 2018, and we started going up in 2019. But the second half of 2019 was still down again. We retested, during the COVID crash, that 4,000 level. So, the main retail market doesn't really give a shit about what's happening for the most part until we hit new all-time highs. So what I'm saying is by the end of this year, I think we personally hit the lows, whatever the lows are, whether that's 11,000, 12,000, whatever, 14,000, whatever. And then, in terms of when do we hit that new all-time high, that's a totally different story, because that's going to definitely take a lot more work. So I just wanted to kind of clarify that.
no, totally. And for me, I tell you what, just me personally, I was right about Cardano last time. Who's that guy that always doubted us? Luca.
Yeah.
Take that, Luca. And if Cardano, I think what we're experiencing right now, obviously it's not fun. I, for one, was constantly saying during the bull market that the bear is coming, guys. The bear is coming. Like this is cool. This is awesome times, but it's not going to last forever. That's why we're stressing take profits.
Yeah, I mean, even CZ was
don't
saying
quit your job.
Yeah, exactly. Even CZ was saying, he was like, I'm surprised we only went to 69K. Like, I thought it was going to be way more than that. Like, for figuring out tops is just for everybody in the market is always way harder than the bottoms. But I mean, you have cycles, right? You must have the good one, and you also must have the
and we
resets.
just experienced the largest printing in human history, so we're going to experience an equivalent downturn. Exactly. But the thing is this too, and this is like full on, for you guys. But they had an interview the other day with President Biden, and he was saying, like, we have to spend all this money because another pandemic is coming. So for me, look, your thoughts on the pandemic may be whatever the fuck it may be, but if you didn't at least raise your eyebrow, like, wait a minute, 99% chance I'm going to survive and we're shutting down the world for this. I think that's the new version of terrorism these days. And that is going to theoretically happen again. Dude, honestly,
way more convert and insidious.
The whole thing they pulled, to mail-in ballots and all that on the totally legit election. If it ain't broke, don't fix it, man. I wouldn't be surprised in 2024. Like, we got another thing, we got a lockdown again. But
war.
That being
war
said,
is a big one on the horizon.
Right. I don't think, dude. I think people are too pussy to go to war. I don't.
Well, it has nothing to do with the people never want to go to war, right? America getting into World War II, I mean, was like clawing tooth and nail.
People cared though. People loved America.
Yeah, well, I mean, there was a narrative for sure, but it took quite a long time into World War, what was considered World War II, before the public was like, okay, we're totally in. But it's the politicians that always get you into it. So I mean, if if the Dems try to have their way, that's one of the biggest potential things.
This was just leading me to my current statement that I'm going to make now. Now is really the most important time to watch the market, because like what Warren Buffett said, right? When the tide goes in, you see who's swimming naked. You're going to see all these companies. Like, dude, honestly, I had my fucking doubts about Celsius, and now we're seeing what's happening.
Voyager just went down.
I was just about to say that Voyager is having trouble. BlockFi is having trouble, and a lot of these coins are shit in the bed. And you're going to see what survives. Like, the real test of time is what coins survive during the bear market. So really, you got to pay attention, and you need to start at home quantifying what are things that, I mean, I'm doing this personally, but what are things that are keeping a project afloat? What are things that were a supposedly good project that are done so right now? For me, I like an overconfident, exuberant kind of, how can I say this? Like kind of maniacal guy, like Do Kwon from UST, from Luna. When the leader has too much hubris, I think that's like a really big red flag, especially nerds with hubris, because they don't they don't calculate. Like nerds with power is the worst thing. Yeah, it's the worst thing. So I think keeping an eye on them and that kind of like, who's like a good leader is CZ, even though he doesn't own
Yeah,
a coin.
he's
He's a
humble.
smart guy. He's very level headed, and he's dominating the world with finance.
Yeah,
But
they're
that
going to
being
hire 2,000 more people this year, and they already got 6K, which is the biggest crypto company, that in existence. So he's doing something right.
Yeah, no, he's playing the right game, the middleman.
Yep.
He's
Take
selling
those fees,
jeans in the
baby.
gold rush.
Hmm.
Shout out to Dan Sparks. He says, "You and Charlie go get a hot Georgia coffee from the vending machine on me. Thanks so much. We can
Hey,
buy
we'll
we can buy
do.
plenty with
With
those.
9.99, hey,
Yeah, the
we'll
yen
get
is
together.
crashing right now, dude. Honestly, not trying to make you guys feel bad, but the yen is crashing and the dollar is soaring. So my rent has like dropped like $1,000, like because I get paid in dollars and I arbitrage to pay in yen. So that's another thing why if you get to the potential to get free financially and get out of the matrix, and there's a lot of people living off of crypto. They create business, tax business, all these things, and you can freely travel the world and use currency arbitrage. Use currency arbitrage within crypto, use currency arbitrage within traditional fiat currencies. And you got to just understand, because what me and Charlie are doing right now with arbitrage and international money changing and crypto changing, this is what bankers have been doing since the dawn of civilization. But now with the proper education and the proper tools at our hands, you can live like them. And when we say financially free, you got to realize this. If you have $3,000 a month in expenses and you make $5,000, you're financially free. It's that
Hmm.
simple. You know what I mean? So don't think it's out of reach. And, you know, we always challenge you guys to educate yourself and push yourself to become better people, because a lot of you guys may have, I mean, I'll say this, if you're watching us now, you're already a cut above the rest,
Oh
because the
yeah.
majority of people have tuned off. Viewership has gone down, consultations, all that stuff, because people are just like, oh, I get crypto's a scam. And these people will be back buying crypto at all times high, ready to fucking make $1 million with a $50 investment. And right now, what we're teaching you guys is the fundamentals, and that's why we're going to be talking about how the economic machine works today with Ray Dalio. It's actually an 8-year-old piece of data here, but it's been translated into multiple languages, and it's a very, very, very good piece of information here that you guys, I mean, I'm probably going to kind of break it down for you guys, because it seems to us that you've been responding very well to the reaction videos, and like we're able to pause and kind of give a layman's breakdown for you guys. And when you guys send super chats and you don't understand something, we can pause a video and elaborate for you, to the quite frankly, to you understand. And we wanted to show you too that, like, again, a lot of people are getting out of crypto right now. They're saying, like, I think, my favorite, he's just a real dickhead of a person. But Doug Polk, the Doug Polk
Yeah.
crypto guy. I don't know if you've ever seen his interview with Dan Bilzerian, but that guy is just a
No.
real shitty individual. He's just like a real shitbag. And he was talking how he knew everything crypto and blah 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 in 2017, and then he just fucked off and went back to his poker bullshit. And
Left in the bear market, typical.
yeah, because he's just quit. He doesn't know what the fuck he's talking about. But when crypto's coming around, you can put blah 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 crypto in your name, take off in the algorithm, and then make a couple bucks from YouTube, make a couple bucks. He was doing some yielding fucking advertisement scam, and of course that company went under. And he's like, "Oh, I'm
Yeah.
so sorry."
This is why we don't like on my channel, we promote and chill ourselves. Hashtag, crypto mindset course, July 22nd, be on the waiting list or be square. But, so we make our own products and we make our own services because, we try to give you guys our honest goodness information of what we think in the market. Versus most of these other people who leave in bear markets don't try to support you guys when times are rough, or try to get you in on lows when you might not be a regular value investor. The types of guys like that, then also they shill Bybit links or whatever,
Right.
or they do this shit like Doug Polk, what you're talking about, and shilling, ridiculous stuff that essentially they're not using, but they give links to their customers because they just want referral fees.
Yeah.
That's all the signs of people that you do not want to follow on crypto. 100%.
No,
I don't know much about Doug Polk except for that I saw him in 2017, but like just generally speaking,
he's a real
yeah, I trust your opinion on that.
Homo sapien. But anyways, going back to that, we're gonna go into today's video. So it's a 31-minute long video. We're gonna be breaking down. Shout out to Hexagon American, $4.99 super chat. Can't wait to dump on the uninitiated. All right, I don't know what that means.
That's the spirit.
Got Hot Rollins says, God damn it, was replaying at 2x. MLD sounds baked now. I'm not baked, but I made a mistake today. I went into my personal trainer, and he's like, it's like a super jacked dude. He's like won championships. I was like, I was kind of like jokingly, I was like, I need you to actually kick my ass today. And dude, I did leg day. No, in the gym.
Oh, okay.
Personal training, and then dude, it was leg day, and like as soon as I got home, I took a shower and laid down. I was asleep for like 3 hours. Like I'm fucking dead, man. I got killed.
Yeah, a lot of people don't know it's like our 11 p.m. right now.
Yeah, and it, like I'm typically bouncing off the walls, but like that guy really killed me in the gym today, man. So yeah, but anyways, thanks to everybody who's watching. Guys, please be sure to hit that like button. And honestly, if you have a friend that needs to learn about cryptocurrency, hit that share button with a friend, family, or loved one, because we are actually suppressed by the algorithm because, crypto is still like, dodgy or whatever. But you guys know that we're here for the good of you guys and the good of our audience. So share this with your friends, families who actually want to learn crypto. You're not going to learn it overnight, but you will learn if you consistently watch us. That being said, let's go and pull up the video. Here we are. Okay. So we're going to get going. Charlie, I shouldn't have an echo, but just let me know, double checking.
How the economic machine works in 30 minutes.
You're good.
The economy works like a simple machine, but many people don't understand it, or they don't agree on how it works. And this has led to a lot of needless economic suffering. I feel a deep sense of responsibility to share my simple but practical economic template. Though it's unconventional, it has helped me to anticipate and to sidestep the global financial crisis, and it has worked well for me for over 30 years. Let's begin. Though the economy might seem complex, it works in a simple mechanical way. It's made up of a few simple parts and a lot of simple transactions that are repeated over and over again a zillion times. These transactions are above all else driven by human nature, and they create three main forces that drive the economy. Number one, productivity growth. Number two, the short-term debt cycle. And number three, the long-term debt cycle. We'll look at these three forces and how laying them on top of each other creates a good template for tracking economic movements and figuring out what's happening now. Let's start with the simplest part of the economy, transactions. An economy is simply the sum of the transactions that make it up, and a transaction is a very simple thing. You make transactions all the time. Every time you buy something, you create a transaction. Each transaction consists of a buyer exchanging money or credit with a seller for goods, services, or financial assets. Credit spends just like money, so adding together the money spent and the amount of credit spent, you can know the total spending.
Can you pause it right there?
The total amount of spending drives the economy.
So that bit of credit there, right? What people often don't realize about that is essentially, right, it's created money, right? Or you can call it fake money, you can call it leverage, whatever you want to call it, right? In crypto specifically, this is what starts getting crypto in trouble, especially in the early days, right? When you get credit just by having assets on exchange and they say, hey, we're going to, give you a little bit more, something like Bybit, like a margin or leverage trading exchange. The more fake money, the more, which is, basically been pumped into the economy since the US dollar was taken off the gold standard, right? And the money printing's just gotten worse and worse and worse, right? That's the stuff that really can get you in trouble as an individual, as well as on the government level and the global economic level. So just a little bit of something to pay attention to there.
Economy. If you divide the amount spent By the quantity sold, you get the price. And that's it. That's a transaction. It's the building block of the economic machine. All cycles and all forces in an economy are driven by transactions. So if we can understand transactions, we can understand the whole economy. A market consists of all the buyers and all the sellers making transactions for the same thing. For example, there is a wheat market, a car market, a stock market, and markets for millions of things. An economy consists of all of the transactions in all of its markets. If you add up the total spending and the total quantity sold in all of the markets, you have everything you need to know to understand the economy. It's just that simple. People, businesses, banks, and governments all engage in transactions the way I just described, exchanging money and credit for goods, services, and financial assets. The biggest buyer and seller is the government, which consists of two important parts: a central government that collects taxes and spends money, and a central bank, which is different from other buyers and sellers because it controls the amount of money and credit in the economy. It does this by influencing interest rates and printing new money. For these reasons, as we'll see, the central bank is an important player in the flow of credit. I want you to pay attention to credit. Credit is the most important part of the economy and probably the least understood. It's the most important part because it's the biggest and most volatile part. Just like buyers and sellers go to the market to make transactions, so do lenders and borrowers. Lenders usually want to make their money into more money, and borrowers usually want to buy something they can't afford, like a house or a car, or they want to invest in something like starting a business. Credit can help both lenders and borrowers get what they want. Borrowers promise to repay the amount they borrow, called principal, plus an additional amount called interest. When interest rates are high, there is less borrowing because it's expensive. When interest rates are low, borrowing increases because it's cheaper.
And right now, interest rates have been risen twice, Charlie? Is it twice or only once so far?
At least twice, yes.
Right. I'm pretty sure it's twice. And then we're expecting 2 more hikes. Theoretically, we're expecting, it's our prediction. Lagarde recently hinted that at the recent ECB that there is going to be a hike in July and then also in September.
Yep.
Because the way you slow down inflation is by you reducing the velocity of money. And the velocity of money is the speed of money moving. So when the interest rates are high, less people are borrowing, therefore less money's flowing around, and you can kind of tame inflation.
Yep, which is definitely necessary to be done. I mean, you basically, when you have all these borrowers out here taking a lot of credit because the interest rates are low, it's the same thing in crypto when you have people basically using leverage, getting high yield, different stuff like this, basically borrowing money. In a market, we know, like with crypto, you just see these things about what Ray Dalio is talking about here. If you just view it in crypto terms, for a lot of people, crypto is some of the industry that they kind of, if they're crypto native, they understand that first. So those analogies are important. But yeah, you tend to see when credit gets abused in any market, right? You have, like you said before, an equal and opposite reaction to that, which now we see with quantitative tightening and increasing interest rates.
When borrowers promise to repay and lenders believe them, credit is created. Any two people can agree to create credit out of thin air. That seems simple enough, but credit is tricky because it has different names. As soon as credit is created, it immediately turns into debt. Debt is both an asset to the lender and a liability to the borrower. In the future, when the borrower repays the loan plus interest, the asset and the liability disappear and the transaction is settled. So why is credit so important? Because when a borrower receives credit, he is able to increase his spending. And remember, spending drives the economy. This is because one person's spending is another person's income. Think about it. Every dollar you spend, someone else earns, And every dollar you earn, someone else has spent. So when you spend more, someone else earns more. When someone's income rises, it makes lenders more willing to lend him money because now he's more worthy of credit. A credit-worthy borrower has two things: the ability to repay and collateral. Having a lot of income in relation to his debt gives him the ability to repay. In the event that he can't repay, he has valuable assets to use as collateral that can be sold. This makes lenders feel comfortable lending him money. So increased income.
That's what a lot of people were handing over their Bitcoin as collateral.
Yep. That's exactly what I was just thinking too. Yep. 100%.
Which is the dumbest shit you can do.
Yeah,
in
not
my
your keys,
opinion.
not your coins. Like if you're gonna do it, you have to have a plan on how to get out, all that stuff. You have to do it responsibly. But some people just trusted these things way too much, right? It was just ridiculous.
Nobody is getting my fucking crypto. Like, I experimentally did a little bit with Boo on Spooky Swap. Made a little coin there, but I didn't put Bitcoin up for it at all.
You just do what is native in that network, right?
Yeah, and then at that time you can unstake it anytime you want, and you never really like fully out of control. But like these corporations like Celsius, BlockFi, hell, even like Bitflyer in Japan, and then Coinbase. If your crypto is in like an exchange, it's not yours. It's just numbers. It's numbers on a screen that make you feel good, but reality is it's not yours.
Yep. And Wes here in the chat has a pretty good comment.
I was gonna put that on there too.
Yep. I mean, all of these things are like, so when people call it crypto Ponzi, it's like, do you know what you're doing in the larger global economy as well? 110%. But I do encourage people, as we're watching this video, just try to think of some of these things in crypto terms as well, because like we just talked about there, right? This is important. And think of other, credit, right? Or leverage or loans or overly excessive yield. What do those things have in common? They're forms of abuse, aka gluttony, right?
Mm-hmm.
And so if you think of other aspects of your life where you have negative effects from, let's say, gluttony, just as a general term, what does that usually do, right? It feels good at first, it goes for a while, like it actually has a benefit for you, and then it just starts dragging you down, right? It's the same thing here with money. If you, like we saw this in 2008, right? When basically the housing market crashed, there were so many people who took out way more credit than they should have been given, simply because of how much fake money was out there and how much credit was out there. It was just easy to get. And those people, they got foreclosed on, they got hit, they got everything taken from them. They got all their assets taken from them. It's the same thing with, Celsius. It's the same thing with, not your keys, not your coins. So, think about it. It's okay to sometimes, take some risk, but don't take excessive risk, essentially.
Absolutely.
Income allows increased borrowing, which allows increased spending. And since one person's spending is another person's income, this leads to more increased borrowing, and so on. This self-reinforcing pattern leads to economic growth and is why we have cycles. In a transaction, you have to give something in order to get something, and how much you get depends on how much you produce. Over time, we learn, and that accumulated knowledge raises our living standards. We call this productivity growth. Those who are inventive and hardworking raise their productivity and their living standards faster than those who are complacent and lazy. But that isn't necessarily true over the short run. Productivity matters most in the long run, but credit matters most in the short run. This is because productivity growth doesn't fluctuate much, so it's not a big driver of economic swings. Debt is, because it allows us to consume more than we produce when we acquire it, and it forces us to consume less than we produce when we have to pay it back. Debt swings occur in two big cycles. One takes about 5 to 8 years, and the other takes about 75 to 100 years. While most people feel the swings, they typically don't see them as cycles because they see them too up close. day by day, week by week. In this chapter, we're going to step back and look at these three big forces and how they interact to make up our experiences. As mentioned, swings around the line are not due to how much innovation or hard work there is. They're primarily due to how much credit there is. Let's for a second imagine an economy without credit. In this economy, the only way I can increase my spending is to increase my income, which requires me to be more productive and do more work. Increased productivity is the only way for growth. Since my spending is another person's income, the economy grows every time I or anyone else is more productive. If we follow the transactions and play this out, we see a progression like the productivity growth line. But because we borrow, we have cycles. This isn't due to any laws or regulations. It's due to human nature and the way that credit works. Think of borrowing as simply a way of pulling spending forward. In order to buy something you can't afford, you need to spend more than you make. To do this, you essentially need to borrow from your future self. In doing so, you create a time in the future that you need to spend less than you make in order to pay it back. It very quickly resembles a cycle. Basically, anytime you borrow, you create a cycle. This is as true for an individual as it is for the economy. This is why understanding credit is so important, because it sets into motion a mechanical, predictable series of events that will happen in the future. This makes credit different from money. Money is what you settle transactions with. When you buy a beer from a bartender with cash, the transaction is settled immediately. But when you buy a beer with credit, it's like starting a bar tab. You're saying you promise to pay in the future. Together, you and the bartender create an asset and a liability. You just created credit out of thin air. It's not until you pay the bar tab later that the asset and the liability disappear, the debt goes away, and the transaction is settled.
This is why people say debt as an asset, just so you guys know. People like sell their debt behind the scenes. That's like when you have a loan, like, oh, your debt used to belong to, I'm going to be going myself way back here, like Washington Mutual sold your debt to, Wells Fargo, and now your debt is owned by them. And typically they sell it at a discount, just to get some cash on hand. So when you have debt, when you hear debt as an asset, it's an asset for the person who the money is owed to. So you got to think of the full spectrum of things, because I know a lot of people say debt is bad, which theoretically, yeah, it is bad, but it's bad
for the person borrowing,
right?
If they do it excessively.
Exactly. And this is how like those same day cash loan places make a lot, make a lot of money.
Well, even you got a lot of those. They got a lot of the same day cash stuff with car, places in the United States. They'll basically sell you a car that they know you can't afford because they know you'll default eventually, and then they'll just come and seize it. And it's super predatory. If done by the wrong organizations.
I mean, it's a big thing, because a lot of these people do that. It's a lot of these companies are
shut up and take my money.
Doing that. They're fucking taking your money. A lot of these companies are predatory. These companies are hoping you do not pay your debt on time.
That's how they make the money.
And when you look at how financially irresponsible the average person is, it's no wonder that these fucking companies and banks and all this shit are making so much money, because the average person, and this is no offense to the audience, but the average person is an incompetent buffoon when it comes to money.
They're not taught anything in school.
I'm coaching a guy now, and God bless him, bless his heart, but he makes $10,000 a month, and he's been doing that since the beginning of 2021. Do you know how much money he has saved up?
Well, he should have a decent amount saved up. I'm just going with what you're probably thinking. I would assume, let's give him a reasonable benefit of the doubt and not say he doesn't hurt it too much, and he's at $20K in savings.
$1,000.
Oh, yikes. I thought for a second there you might go negative too. I was like, oof, that'd be O's money.
$1,000 makes $10,000 a month. Monthly expenses are about $3,500 a month, and he is blowing his money on going out, drinking, going to restaurants. And I just keep telling him, I said, listen, dude, you are spitting in the face of God in the way you're acting. Not to get all religious, but you can't continuously get money like this and be irresponsible with it and think everything's going to be okay down the road. This irresponsible behaviors are down to an irresponsible character. And I was actually kind of yelling at him. I was like, you need to fucking get it together, dude. There's people out here suffering in this economy, and you're making shitload of money. And it's pretty bad. It's unfortunate, but that's why we're just here telling you guys, like, these people, and look, these crypto companies are no different, man. Nobody gives a fuck about you guys. Nobody cares. They don't care if you're financially free. They don't do you're going to find people like us who actually sit there and grind out like 40, 50 hours worth of webinars behind the scenes, educating you guys on how to get your shit sorted. People like us, we actually care. I give a fuck about my guys in my community, but guys in my community.
Hell yeah.
But these companies, these crypto companies, these banks, these governments, they don't give a shit about you. And quite frankly, it's in their financial interest for you to fuck up.
Mm-hmm. Yep. And yeah, looking at incentives in every structure is super important. I don't know how many of you guys out there know Anton Kreil, Kreil, I believe. He is a bit bombastic and whatever, but he's an ex-Wall Street guy. Go and watch his video. I think it's called Why the Stock Market Doesn't Make Money or something like this. But essentially, he literally breaks down how the incentive structures are fit in the traditional stock market and why it's not really made for you to make money. Clearly, it's obviously for the banks. And that happens in every single industry. The longer the industry, goes, the more corrupted it gets, essentially. Humans just tend to corrupt things, even if, Bitcoin itself is not something to be corrupted, right? They can go, with things around that, services around that, like loans and lending and stuff like this, to find ways to corrupt the end user, essentially, because, we know humans are usually the place where mistakes are made. But if you don't take this responsibility seriously of understanding these types of things about money, relating it to crypto, relating it to the stock market, relating it to real estate, if you don't take that responsibility and you just frivolously spend your money and you're making a lot, it's not going to end well, not by any means. So even if you're making a little, right, if you're doing it properly, you can grow quite well, especially if you understand how crypto works, because it is the fastest growing asset out there for Bitcoin and Ethereum in particular. So doing the work with this type of stuff is just massively important. So for I think it's 400 or 375 people watching us now, smash that like button and hit subscribe if you want this information more, but also we appreciate that you guys are here and taking it in and doing the work.
And shout out to Simp TYMA Australian, $2 Australian. It says, thank you for the value you provide us. Yep, we're going to be here. We're not going anywhere. We're going to be here in the fucking thick of it. And we're going to be here in the depths of the fucking bear market. We're already here, really. And when we go back up in the bull, we're going to be here. We're going to be partying and having a good time. And then we're going to be depressed with you again. We're going to ride this bad boy all the way to the grave. So, here we go. Let's continue.
The reality is that most of what people call money is actually credit. The total amount of credit in the United States is about $50 trillion, and the total amount of money is only about $3 trillion. Remember, in an economy without credit, the only way to increase your spending is to produce more. But in an economy with credit, you can also increase your spending by borrowing. As a result, an economy with credit has more spending and allows incomes to rise faster than productivity over the short run, but not over the long run. Now, don't get me wrong. Credit isn't necessarily something bad that just causes cycles. It's bad when it finances overconsumption that can't be paid back. However, it's good when it efficiently allocates resources and produces income so you can pay back the debt. For example, if you borrow money to buy a big TV, it doesn't generate income for you to pay back the debt. But if you borrow money to, say, buy a tractor, and that tractor lets you harvest more crops and earn more money, then you can pay back your debt and improve your living standards. In an economy with credit, we can follow the transactions and see how credit creates growth. Let me give you an example. Suppose you earn $100,000 a year and have no debt. You are creditworthy enough to borrow $10,000, say on a credit card. So you can spend $110,000 even though you only earn $100,000. Since your spending is another person's income, someone is earning $110,000. The person earning $110,000 with no debt can borrow $11,000, so he can spend $121,000, even though he has only earned $110,000. His spending is another person's income, and by following the transactions, we can begin to see how this process works in a self-reinforcing pattern. But remember, borrowing creates cycles, and if the cycle goes up, it eventually needs to come down. This leads us into the short-term debt cycle. As economic activity increases, we see an expansion, the first phase of the short-term debt cycle. Spending continues to increase and prices start to rise. This happens because the increase in spending is fueled by credit.
And that's probably why during the Corona money printing fiasco, we had price of Rolexes going up, price of crypto going up, price of houses going up. I mean, every fucking thing. They were talking about, like, there was a Rolex. Did you hear about this? They're like, oh, there was a Rolex bull market going on. Did you hear about that?
Yeah.
You know?
Yeah, I heard a lot about it from you.
Yeah, exactly. So that's what we have here. And yeah, man, this is what was happening in not really so much 2020, but definitely 2021. You know, and just a quick little thing to tell you guys what's happening economically over here in Japan. So I go to these islands called Okinawa in the summer.
You may have heard of them.
Right. Well, a lot of people don't know about it.
Well, yeah, I mean, if they study World War II, I'm just saying, yeah.
Oh, yeah. And there's a beautiful island called Miyakojima. I go there, and I was there just a couple weeks ago. And the last summer I was there, and I went to Okinawa 4 times last summer with 4 different girls, but that's a whole different story. But last year when I went to multiple islands with multiple chicks and multiple hotels, and it was pretty barren last year because, you know, Japanese people are very obedient to the NHK, which is like the PBS equivalent, and they are, you know, constantly terrified of masks. Everybody here's still wearing masks and shit, and you know, a lot of Japanese people were just staying home, saving all their money, not doing shit. And then this year, you know, the islands were packed, sold out. We couldn't even get a rental car. I had to rent this friggin' VW Beetle convertible. It was like the only car available. Like literally every car they had was sold out. And so you had a lot of people like stored up, you know, with all their money and not really spending it. And then, you know, they had like this burst. And I think that's what happened in 2021. All these people were, you know, locked up in 2020, sexually deprived and all this stuff. And then finally they're like, okay, I'm going to get out there. And there's a lot of sex going on. There was a lot of spending going on. People were just happy.
Especially domestic or international travel is very difficult right now. So people are going to stay way more domestic too.
Yeah. And so that's what we have: expansion, prices going up. And now we're going to experience the downside.
Prices start to rise. This happens because the increase in spending is fueled by credit, which can be created instantly out of thin air. When the amount of spending and incomes grow faster than the production of goods, prices rise. When prices rise, we call this inflation. The central bank doesn't want too much inflation because it causes problems. Seeing prices rise, it raises interest rates. With higher interest rates, fewer people can afford to borrow money, and the cost of existing debts rises. Think about this as the monthly payments on your credit card going up. Because people borrow less and have higher debt repayments, they have less money left over to spend. So spending slows. And since one person's spending is another person's income, incomes drop, and so on and so forth. When people spend less, prices go down. We call this deflation. Economic activity decreases, and we have a recession. If the recession becomes too severe and inflation is no longer a problem, the central bank will lower interest rates to cause everything to pick up again.
Can you pause it there?
With low interest rates,
So that's really the one thing we haven't quite seen yet, is that deflation start to kick in, where prices on things start to go lower. But essentially, if you take a look at I think it was Michael Burry, the guy from the Big Short was based on. He's recently talking about Walmart, Target basically having excess inventory, basically due to a lot of supply chain issues, right? And a lot of people at the retail side getting hurt by this credit crunch essentially, and high interest rates. And what you'll see these big stores have to do is they need to get rid of this stuff, right? And so there will be some deflation around the corner with, prices of stuff actually going down, and people be like, oh, great. I can buy things again, with my normal income, but not as much with credit. And then you get the situation he's describing now. And then the interest rates, that's when you could potentially go down. And then you see that you'll probably see that towards like the middle of the recession, which probably would be more towards like the end of this year or beginning of next year.
Hurry up.
Right.
Payments are reduced and borrowing and spending pick up, and we see another expansion. As you can see, the economy works like a machine. In the short-term debt cycle, spending is constrained only by the willingness of lenders and borrowers to provide and receive credit. When credit is easily available, there's an economic expansion. When credit isn't easily available, there's a recession.
Right.
And note that this cycle is controlled primarily by the central bank. The short-term debt cycle typically lasts 5 to 8 years and happens over and over again for decades. But notice that the bottom and top of each cycle finish with more growth than the previous cycle and with more debt. Why? Because people push it. They have an inclination to borrow and spend more instead of paying back debt. It's human nature. Because of this, over long periods of time, debts rise faster than incomes, creating the long-term debt cycle. Despite people becoming more indebted, lenders even more freely extend credit. Why? Because everyone thinks things are going great. People are just focused on what's been happening lately.
Yep.
And what's been happening lately? Incomes have been rising. Asset values are going up. The stock market roars. It's a boom. It pays to buy goods, services, and financial assets with borrowed money. When people do a lot of that, we call it a bubble. So even though debts have been growing, incomes have been growing nearly as fast to offset them. Let's call the ratio of debt to income the debt burden. So long as incomes continue to rise, the debt burden stays manageable. At the same time, asset values soar. People borrow huge amounts of money to buy assets as investments, causing their prices to rise even higher. People feel wealthy. So even with the accumulation of lots of debt, rising incomes and asset values help borrowers remain creditworthy for a long time. But this obviously cannot continue forever. And it doesn't. Over decades, debt burdens slowly increase, creating larger and larger debt repayments. At some point, debt repayments start growing faster than incomes, forcing people to cut back on their spending. And since one person's spending is another person's income, incomes begin to go down, which makes people less creditworthy, causing borrowing to go down. Debt repayments continue to rise, which makes spending drop even further. And the cycle reverses itself. This is the long-term debt peak. Debt burdens have simply become too big. For the United States, Europe, and much of the rest of the world, this happened in 2008. It happened for the same reason it happened in Japan in 1989 and in the United States back in 1929. Now the economy begins deleveraging.
Can you pause it there for a moment? The one bad thing about, the 2008, 2009 crash essentially is with bailing out all the banks, right? It essentially kicked the can down the road for that deflationary environment, which we're basically going through more roughly now. And there's a few people in the chat saying, well, what happens, when you keep, how long can you keep pulling this lever of, inflation, high interest rates, money printing, basic, or like going between the high interest rates and money printing, essentially how long can you go between those two things until the lever literally breaks? What we've been doing since we got off the gold standard and Nixon's, presidency in the early 70s is we've been testing that lever to the fucking extreme. And by bailing out all the banks in 2008, essentially we keep it going. So it'll be interesting to see, interesting in an objective sense, not in a subjective sense, because a lot of people are going to go through pain, but it will be interesting to see kind of, like we said before, if they do have to get into the area where deflation is happening and then they have to lower interest rates again, will that, continue kicking this can down the road? Because essentially with all this inflation, what we're doing is we're stealing from the future, not only for us as individuals who are getting credit, but for the entire world economy. And the more that you do that, there can be an area where it breaks. So this is the one terrible fallacy of Keynesian economics, which is essentially that, debt is great and it will always be okay. We saw, especially with Zimbabwe and the Weimar Republic, things can break. And not saying that situation is necessarily going to happen at some point, but it is possible. So again, going back to, if you're not worried about those types of things, then, you basically won't see them coming. But if you do worry about these things, even if, they might be a little bit on the horizon or down the road, or they might not happen, then at least you'd be prepared in any scenario, right? It's kind of like, hey, get rich, because if the world goes to shit, you'll be rich. But if the world doesn't go to shit, you'll be rich. So either way you win. So it's the same thing with what Dalio was talking about last week with the worry.
Yeah. And we got some super chats real quick. Kyle's hitting up both of our channels, $6.99 Canadian fire content. The series is awesome. Get likes up. And then likes up, fire content, insight from the dynamic duo. Thanks so much, brother, man.
Leveraging, people cut spending, incomes fall, credit disappears, asset prices drop, banks get squeezed, the stock market crashes, social tensions rise, and the whole thing starts to feed on itself the other way. As incomes fall and debt repayments rise, borrowers get squeezed. No longer credit worthy, credit dries up, and borrowers can no longer borrow enough money to make their debt repayments. Scrambling to fill this hole, borrowers are forced to sell assets. The rush to sell assets floods the market at the same time as spending falls. This is when the stock market collapses, the real estate market tanks, and banks get into trouble. As asset prices drop, the value of the collateral borrowers can put up drops. This makes borrowers even less creditworthy. People feel poor. Credit rapidly disappears. Less spending, less income, less wealth, less credit, less borrowing, and so on. It's a vicious cycle. This appears similar to a recession, but the difference here is that interest rates can't be lowered to save the day. In a recession, lowering interest rates works to stimulate borrowing. However, in a deleveraging, lowering interest rates doesn't work because interest rates are already low and soon hit 0%. So the stimulation ends.
How long were we at 0% for?
I don't remember how long we were there for, but
years, right?
We never went negative in the United States, I believe, but in most, like in Europe, it actually happened quite a lot. Which means basically, if you put money in the bank, you owe them money just for holding your goddamn money.
Yeah, sounds fair.
Yeah.
Interest rates in the United States hit 0% during the deleveraging of the 1930s, and again in 2008. The difference between a recession and a deleveraging is that in a deleveraging, borrowers' debt burdens have simply gotten too big and can't be relieved by lowering interest rates. Lenders realize that debts have become too large to ever be fully paid back. Borrowers have lost their ability to repay and their collateral has lost value. They feel crippled by the debt. They don't even want more. Lenders stop lending, borrowers stop borrowing. Think of the economy as being not creditworthy, just like an individual. So what do you do about a deleveraging? The problem is debt burdens are too high and they must come down. There are 4 ways this can happen. 1, people, businesses, and governments cut their spending. 2, debts are reduced through defaults and restructurings. 3, wealth is redistributed from the haves to the have-nots. And finally, 4, the central bank prints new money. These 4 ways have happened in every deleveraging in modern history.
Pause it there and go back to that image.
Which one?
The image where they had all, there we go. So just kind of a little pop quiz, 1 on the left, 4 on the right. 1 for cut spending, 2 for reduce debt, 3 for redistribute wealth, or 4 for print money. Which one do you think the governments and people are most likely to accept, right? Are people going to want to cut spending when Ray is obviously talking about them taking credit and borrowing money is their default option? Probably, well, I'm not going to influence your decision there. Reduce debt, which basically means they don't want to take out as much money as they could have before. 3, redistribute money, essentially UBI, right? How many people are going to be good with that? Some, but not all. Maybe, right? Or print money. Which one do you think people and the governments are going to choose, right? Pretty much, yeah. We see a lot of 4s in the chat, right? Money printer go burr is the easiest thing, but it's gluttony on a global scale. The one thing I highly recommend people to go watch is a documentary called Princes of the Yen by Richard Werner. Richard Werner is amazing at talking about central banks globally. If you just go listen to him, like, it's a breath of fresh air. But the Princes of the Yen essentially talks about how Japan essentially forced itself into a recession in the late 80s and then continue to suppress things in their economy over time. And right now we're experiencing something very similar on a global scale. So a lot of the one bank that we talked about last week when we were watching some of the discussion with the ECB, they're basically the one bank that nobody ever talks about is the Bank of International Settlements. And that's the bank that you're going to, that fat guy last week was, basically working for. Pay attention to what they're doing, because as the global economy is more integrated, right? These guys who are running all these central banks, man, they get up to some pretty nifty stuff, but money printing is their MO, essentially. So yeah, I see a ton of 4s in the chat.
Mm-hmm.
Every deleveraging in modern history. Usually spending is cut first. As we just saw, people, businesses, and even governments tighten their belts and cut their spending so that they can pay down their debt. This is often referred to as austerity. When borrowers stop taking on new debts and start paying down old debts, you might expect the debt burden to decrease. But the opposite happens. Because spending is cut and one man's spending is another man's income, it causes incomes to fall. They fall faster than debts are repaid, and the debt burden actually gets worse. As we've seen, this cut in spending is deflationary and painful. Businesses are forced to cut costs, which means less jobs and higher unemployment. This leads to the next step. Debts must be reduced. Many borrowers find themselves unable to repay their loans, and a borrower's debts are a lender's assets. When a borrower doesn't repay the bank, people get nervous that the bank won't be able to repay them, so they rush to withdraw their money from the bank. Banks get squeezed, and people, businesses, and banks default on their debts. This severe economic contraction is a depression. A big part of a depression is people discovering much of what they thought was their wealth isn't really there. Let's go back.
Would you say we're in a kind of a crypto depression right now, Charlie?
Yeah. I mean, is one of the first things
Recession
to
or
go down.
depression?
Capitulation. I mean, it works because crypto, essentially, it works a little bit different than other markets because, and this is one thing that has been changing a little bit with the high yield stuff. But at the end of the day, in crypto, literally the worst thing that they can do is just take all your assets, which is your Bitcoin, your Ethereum, whatever you put up as collateral for, basically taking those loans, getting that leverage or getting that yield. Right. So the worst thing in crypto is you can get zeroed out, but in some of these other markets, you can literally owe money back and go to the negative and just be a debt slave. So that's the big difference between crypto and the traditional markets. It's more acting more on a Austrian economic type thing where it's like, hey, you can go to zero, right? Versus Keynesian economics says you can go to more than zero. So a lot of people don't like Austrian economics because there's more frequent recessions, but they're a lot smaller, and you tend to be able to bounce back from them. So Bitcoin, if you go back to zero and you're not negative, well, or if you go back to, down worse than where you were started, like you can still make that money back, versus in traditional markets, sometimes you literally go back in the days of the early industrial age, you literally went to debtor's prison for this shit. Right. So that's the difference between the two systems.
Icarus 13075 Great British Pound says, hey, Charlie, have you ever read the book, A History of Central Banking and the Enslavement of Mankind? Got banned off of Amazon. Very telling.
I have not read that one yet, but that sounds fucking interesting as hell. The one thing that does remind me of is Jekyll Island, the monster. If you go and watch or if you look at that book as well, it basically talks about how that system was created. But yeah, very telling indeed.
Let me take a look here. I'm looking at it. It looks like it's available on barnesandnoble.com.
They're going down. They haven't made money in years, so they need it, all the money they can get.
Do you remember Books a Million? Did you ever go there?
No, I didn't.
I used to love going to Books a Million.
I did like Barnes and Nobles too.
Here's the book the gentleman in the chat is talking about right there. Looks like it is by Stephen Mitford Goodson. Only has 2 reviews, 5 stars. A History of Central Banking and the Enslavement of Mankind. Nook Book. What is this? A Nook Book this is their version of the Kindle.
That was a terrible name.
And absolutely. Let's see what this is. Masterpiece will make you think. I work in banking and have my whole career. Love economics. I've never read such an interesting historical review of banking and the trajectory over time. I will tell you guys this. This is good. I'm going to try to figure out a way to get that over here in Japan. I'm going to read it. I will tell you guys this, and this is really important. It is in your guys' best interest right now to learn as much as you can about the financial markets right now in these down times. I mean, I'm talking oils, okay? I'm talking the 10-year treasury bond for the United States. I'm talking the CPI. I mean, you should be really diligent in your study in these times of depression and recession, because it is never a negative asset. Like, knowing how money works in and out, it's like it can't be a net negative for you. It
allows you to benefit from the down times, and you actually, like, the more you understand, the more you get excited about these times, because this is where the true wealth is created. But 80% of people don't experience that because they aren't educating themselves.
Here we go.
Back to the bar. When you bought a beer and put it on a bar tab, you promised to repay the bartender. Your promise became an asset of the bartender. But if you break your promise, if you don't pay him back and essentially default on your bar tab, then the asset he has isn't really worth anything. It has basically disappeared. Many lenders don't want their assets to disappear and agree to debt restructuring. Debt restructuring means lenders get paid back less, or get paid back over a longer time frame, or at a lower interest rate than was first agreed. Somehow, a contract is broken in a way that reduces debt. Lenders would rather have a little of something than all of nothing. Even though debt disappears, debt restructuring causes income and asset values to disappear faster, so the debt burden continues to get worse. Like cutting spending, debt reduction is also painful and deflationary. All of this impacts the central government because lower incomes and less employment means the government collects fewer taxes. At the same time, it needs to increase its spending because unemployment has risen. Many of the unemployed have inadequate savings and need financial support from the government. Additionally, governments create stimulus plans and increase their spending to make up for the decrease in the economy. Governments' budget deficits explode in a deleveraging because they spend more than they earn in taxes. This is what's happening when you hear about the budget deficit on the news. To fund their deficits, governments need to either raise taxes or borrow money. But with incomes
Traditionally, I mean, this ain't even fucking real. Raise taxes to cover their deficits. I mean, is there a ledger for the government spending?
Not publicly and not with any honesty.
Fuck this. This is fucking garbage.
I mean, it's like people call Bitcoin or crypto a Ponzi scheme. The traditional space is like a million times worse. You know, I mean, Bitcoin was created literally in a response to this, you know, of the 2008, bailouts essentially.
falling and so many unemployed, who is the money going to come from? The rich. Since governments need more money and since wealth is heavily concentrated in the hands of a small percentage of the people, governments naturally raise taxes on the wealthy, which facilitates a redistribution of wealth in the economy from the haves to the have-nots. The have-nots who are suffering begin to resent the wealthy haves. The wealthy haves, being squeezed by the weak economy, falling asset prices, and higher taxes, begin to resent the have-nots. If the depression continues, social disorder can break out. Not only do tensions rise within countries, they can rise between countries, especially debtor and creditor countries. This situation can lead to political change that can sometimes be extreme. In the 1930s, this led to Hitler coming to power, war in Europe, and depression in the United States. Pressure to do something to end the depression increases. Remember, most of what people thought was money was actually credit. So when credit disappears, people don't have enough money. People are desperate for money, and you remember who can print money? The central bank can. Having already lowered its interest rates to nearly zero, it's forced to print money. Unlike cutting spending, debt reduction, and wealth redistribution, printing money is inflationary and stimulative. Inevitably, the central bank prints new money out of thin air and uses it to buy financial assets and government bonds. It happened in the United States during the Great Depression, and again in 2008 when the United States Central Bank, the Federal Reserve, printed over $2 trillion. Other central banks around the world that could printed a lot of money too. By buying financial assets with this money, it helps drive up asset prices, which makes people more creditworthy. However, this only helps those who own financial assets. You see, the central bank can print money, but it can only buy financial assets. The central government, on the other hand, can buy goods and services and put money in the hands of the people, but it can't print money. So in order to stimulate the economy, the two must cooperate. By buying government bonds, the central bank essentially lends money to the government, allowing it to run a deficit and increase spending on goods and services through its stimulus programs and unemployment benefits. This increases people's income as well as the government's debt. However, it will lower the economy's total debt burden. This is a very risky time. Policymakers need to balance the four ways that debt burdens come down. The deflationary ways need to balance with the inflationary ways in order to maintain stability. If balanced correctly, there can be a beautiful deleveraging. You see, a deleveraging can be ugly or it can be beautiful. How can a deleveraging be beautiful? Even though a deleveraging is a difficult situation, handling a difficult situation in the best possible way is beautiful. A lot more beautiful than the debt-fueled, unbalanced excesses of the leveraging phase. In a beautiful deleveraging, debts decline relative to income, real economic growth is positive, and inflation isn't a problem. It is achieved by having the right balance. The right balance requires a certain mix of cutting spending, reducing debt, transferring wealth, and printing money so that economic and social stability can be maintained. People ask if printing money will raise inflation. It won't if it offsets falling credit. Remember, spending is what matters. A dollar of spending paid for with money has the same effect on price as a dollar of spending paid for with credit. By printing money, the central bank can make up for the disappearance of credit with an increase in the amount of money. In order to turn things around, the central bank needs to not only pump up income growth, but get the rate of income growth higher than the rate of interest on the accumulated debt. So what do I mean by that? Basically, income needs to grow faster than debt grows. For example, let's assume that a country going through a deleveraging has a debt-to-income ratio of 100%. That means that the amount of debt it has is the same as the amount of income the entire country makes in a year. Now think about the interest rate on that debt. Let's say it's 2%. If debt is growing at 2% because of that interest rate, and income is only growing at around 1%, you will never reduce the debt burden. You need to print enough money to get the rate of income growth above the rate of interest. However, printing money could easily be abused because it's so easy to do and people prefer it to the alternatives. The key is to avoid printing too much money and causing unacceptably high inflation the way Germany did during its deleveraging in the 1920s. Policymakers achieved
the Weimar Republic, right? It's like people don't think it can happen in the United States or happen to the, to us, but
This is, somebody here says, "Do I see Biden there?" Look, it's like it's like it was Obama, it was Bush, it was fucking Clinton, it was Trump.
Everybody since Nixon.
Do you remember, Charlie, when we were little? We got the well, I don't know if you got it, but I got the $600 from George W.
I don't remember that, but I do remember that. I probably did. I just don't remember it. But like I do remember, obviously, the stuff during the Corona crash and all that.
Shout out to Max. Max says BRB, buying a wheelbarrow. But yeah, this is why I say, and this is kind of a stretch, but look, we always advise you guys to be above average, and this is why when you have a cash flowing business, you can kind of combat inflation by raising your prices. You can kind of, because your income doesn't raise as fast as you can raise the prices of your courses, your consultations, your food on the menu, if you're like Miguel, your lawn cutting services. He had a landscaping business for many years. So that's why we were telling you guys, and the yielding is not a cash flowing business. Crypto yield. Oh God. All right, let's go back to this before I have an aneurysm. People treating crypto yield as an income stream was just blowing my mind.
Yeah, it's an abuse. Like if you use it, there are some responsible platforms. Basically, if you use them, for a little bit, but most of them, because it was the first time it was being done in crypto, went fucking nuts. But yeah,
man. All right, let's go.
The right balance. A deleveraging isn't so dramatic. Growth is slow, but debt burdens go down. That's a beautiful deleveraging. When incomes begin to rise, borrowers begin to appear more creditworthy. And when borrowers appear more creditworthy, lenders begin to lend money again. Debt burdens finally begin to fall. Able to borrow money, people can spend more. Eventually, the economy begins to grow again. leading to the reflation phase of the long-term debt cycle. Though the deleveraging process can be horrible if handled badly, if handled well, it will eventually fix the problem. It takes roughly a decade or more for debt burdens to fall and economic activity to get back to normal, hence the term lost decade. In closing, of course, the economy is a little bit more complicated than this template suggests. However, laying the short-term debt cycle on top of the long-term debt cycle, and then laying both of them on top of the productivity growth line, gives a reasonably good template for seeing where we've been, where we are now, and where we're probably headed. So, in summary, there are 3 rules of thumb that I'd like you to take away from this. First, don't have debt rise faster than income, because your debt burdens will eventually crush you. Second, don't have income rise faster than productivity, because you'll eventually become uncompetitive. And third, do all that you can to raise your productivity, because in the long run, that's what matters most.
Pause that.
And that is what China is doing way better than America, mainly because basically slave labor is okay over there.
Yeah, that being said, they do have shells in terms of real estate, right? They overproduced basically in terms of real estate, where they have buildings that literally have nobody in them, just, you know, empty shit. And that's China. That's always China's Achilles heel, right? Is like they find a way to do something really, really well. And I mean, obviously doing it through slave labor is terrible, but it's effective for them. But then they find a way to be gluttonous and over exceed their limits. It was the same as that bullet train story I was giving the other week, where they bought the Mitsubishi bullet train or Shinkansen from Japan. They said, don't run this thing over, let's say, for example, 200 kilometers an hour. What do? They run it at 250, 275. It falls off the track. They literally try to bury it under the ground because it's happened at night before the daylight gets out there, so reporters don't see this shit, right? So China's Achilles heel is always they go for quantity, not quality, and it does bite them in the ass eventually. So that's their Achilles heel that we should be watching out for as well.
Yeah. Let's continue.
This is simple advice for you, and it's simple advice for policymakers. You might be surprised, but most people, including most policymakers, don't pay enough attention to this. This template has worked for me, and I hope it will work for you. Thank you.
Nice.
So a very I just think people kind of shit on it for saying like, you know, oh, this is like a kiddie shit or whatever. But dude, that is like so, even with us digesting and breaking it down, still very complicated stuff.
Yeah, it's very important information. It's critical. The one thing is it goes back to that thing we were saying about being humble versus being arrogant, right? A lot of people who it's kind of like the phrase "kiss, keep it simple, stupid,"
Yeah.
Right? The more you complicate these things, because everybody wants to complicate because they want to feel like the smartest person in the room. They're like, oh yeah, I already understand this stuff, but they don't go back and they remind themselves of these things, right? So it's that spaced repetition. So I think this information is extremely relevant for people who already know all this information, because it gets a discussion going. You can see a really good discussion going in both of our chats. But a lot of stuff that we weren't able to touch on, but that we kind of casually mentioned throughout our discussion of this as well. So it's great for beginners as well as people who are advanced. For beginners, it gets them like the taste of some of this lingo, and it gets them hopefully going out there and taking the best resource, which is Google, taking that information, putting it in there and starting to figure it out. And for the people who already know this stuff, right, you have time in here to talk with a lot of really like-minded people in the chat, see a few things that maybe you didn't hear before, like the documentary, The Princes of the Yen. I'm pretty sure a lot of people do not know who Richard Werner is. If you go on Valuetainment as well, they interviewed Richard Werner as well as Danielle Danielle Booth is her name. She used to work for the Fed. She was on Valuetainment for a while, or she still is. But she also had an interview on her channel. I forget what it's called, but with Richard Werner. And like this type of extra little bit of information here and there. Like if you go and read that book that I think it was Icarus was mentioning, good name, by the way. And so, yeah, if you go out there and you just take one of those little things and then you use that to springboard off for just a little bit more knowledge, you win. But if you're like, oh yeah, I got this shit down, bro, like this is kiddie shit, like I don't need to hear about this, you're just not using resources properly, and you're not taking advantage of the situation, in my opinion. So keep fucking learning and keep going out there and producing stuff that's valuable, and you will never be poor.
Yeah, man. Like I said, it can be a lot. And then you could just go onto Google and type in Ray Dalio, or excuse me, YouTube, type in Ray Dalio, and then how the economic machine works. But I would advise you guys, just me personally, every day that I wake up and live my life, there's two things I do. I make sure I exercise, and I make sure I consume some sort of data that is going to teach me something valuable. Okay. And recently I've been just consuming a lot of business stuff, investing stuff, and money stuff just in general, because I'm noticing that more and more audience members are reaching out to me, Charlie as well, and just trying to increase their financial literacy. And I'm telling you guys, it is never a net negative for you to get better at understanding money. And crypto is the newest money on the planet. I had a consultation with a gentleman today who does very well for himself, in almost 8 figures, mid 30s. Not going to go into any more details than that, but all through crypto. There's money out there, guys, and it's out there for anybody. It doesn't matter if you're a man, woman, black, white, Asian, whatever. If you do the work, you put the effort in, and effort is a great equalizer. You have the internet, you have all the resources in the world today, and quite frankly, if you're in a first world country and you can hear the sound of our voice and you're poor, it's 1,000% your fault. If you're not, unless you're like physically handicapped, I understand. Other than that, it's your fault, boys. That's all we got to say. We'll be back here tomorrow on my channel, 9 a.m. Eastern Standard Time. We'll be talking more about the Masculine Empowerment Network, and then Charlie, 8 a.m. Eastern Standard Time on his channel tomorrow. Until then, we'll see you guys next time.